Thanks, Ted. You're a real hoot. Well, I can't start out any other way than say howdy. Howdy. One more time, howdy. Howdy. Okay, Colleen Conrad asked me to tell you why I do that. It's not because I'm a Texan, it's because I'm a Texas Aggie. And we don't have fans, we have Aggies. We're just Aggies, we're not fans. At A&M, there's a tradition. When you hit the campus as a freshman, you learn very quickly that when you pass somebody anywhere, on campus or anywhere, you look them in the eye and you say howdy as you're passing. It's kind of given us the, kind of a denotation of being a friendly campus, but because everybody speaks. But it's just part of the tradition, and you do that. And when you speak at A&M or around the country as an Aggie, you always start out with howdy, because that's just part of our character and part of what we are. That's where that all comes from. And Colleen asked me to explain that, and I appreciate her asking me. I just assumed everybody knew. It's good to be here, especially in the presence of Bill Tracy, one of my great friends. I'm sitting by him. I asked him if he wanted me to start sending him all my Rick Perry information I get by email. He assured me he didn't. But Bill Tracy is one of the most successful guys I know. You've heard of SDSI, semi-dependent self-directed semi-independent agency status. And if you would change your state law to where your accountancy board could obtain SDSI status, you too could drive a Lexus like Bill Tracy drives. I told him that once you get old enough to afford a good sound system, you couldn't hear it. It's good to be here, and I'm probably already working in on Noel Allen's time, so I will blame it on Louise, because she made us all wear a tie. I have some slides in here. There's about 40 plus slides, and I cannot go through them with you for a couple of reasons. One, there's too many, so it's there as your reference, and I'm going to go hit some high points. And the other is that about half the group in here doesn't know what they're all about anyway, and I don't blame you. You're actually better off than the other half of us. Accounting standard setting, particularly for private company financial statement users, the preparers, and of course the practitioners, is the topic. And I've spent the last 2.5 years delving into that for one reason: you asked me to. So thank you. That back of the bus, back and forth from Houston to LaGuardia is indeed fun. LaGuardia, when you get off the airplane, it's like being in a third world country. But I've enjoyed the ride. As you know, my term will end at the end of this year, and I'm not seeking an additional term. The reason really why is because it's getting too hard. The other thing is that most of the terms that I've been on the state board and anything else I've been involved in, I've usually gone one term and then I get out of the way. I think that I've always respected that in people. I don't like to hang around. There's always other things you can do. And I didn't know this thing was out there until it came to me, but I appreciate the nomination, the confidence that came from this body, and hopefully I have upheld your expectations in doing that. I can assure you that the other 9 people have certainly done a great job. But the other reason that I'm stepping down, not other than the fact that the 3-year term is over and I'm not seeking another term, is that I'll be 65 years old next month. And accounting standard setting is not on my bucket list. So please know that. But enough said about that. What I want to try to do is take you through just some of the highlight things. You can flip through the stuff that's in your binder when I get down into the progress. First thing I want to do is I want to recognize the other 9 members of the PCC who have day jobs. I don't, not really, but they do, and that gives them very high level of relevance to what we do. They come from financial statement users, venues. They come from preparers, which is CFOs or controllers, and then there's practitioners equally spread that are active in private company financial reporting and that sort of thing, and interpretation and following the standards. As you know, that body was created by the Financial Accounting Foundation. I don't know if any of this is in the And my slides, yeah, Financial Accounting Foundation, which is the umbrella organization that writes the paychecks for the FASB and the GASB. They've hosted the PCC after about a 2-year or so study into what needed to be done, if anything, with regards to private company accounting standards and the relevance of those standards, the complexity of those standards, and the excess cost of those standards might have on private companies versus public companies. So it morphed into, if you will, over time through due process, due diligence, and a lot of public input into the creation of the Private Company Council, which I said has 10 members, including myself. Our responsibility is to identify, deliberate, and vote on proposed GAAP, which is generally accepted accounting principles, alternatives for private companies. It is an advisory body to the FASB. It is a deliberatory body. We deliberate in our meetings, and our meetings are open to the public. The FASB board members all sit in our meetings and participate. My job is to referee the big table that has 9 PCC members, 7 FASB board members, and then the staff that are assisting us that come in and out to various meetings. Many of you have attended those meetings. Many people from the AICPA have, all as interested stakeholders. And I think the meetings have gone pretty well. I think I've had about 13 or 14 meetings today. We meet about 5 times a year. Plus I meet a 6th time with the FAF trustees in November to kind of go over where we are and where we're headed and what my views are. But the 9 members on the PCC have all done a great job. I hold them all out to you. One of them, George Beckwith, is going to speak at the East Regional meeting, and I appreciate George doing that. He's the CFO of National Gypsum, which is a fairly large private company, and has done just a great job in his participation. Secondly, I really thank the FAF trustees, particularly Mac Lawhon, who has been very friendly to me. We've known each other for a long time through the Texas Society of CPAs. We served on the board together, the executive board of Texas Society, and Mac has been a very good leader of this strategy deployment by the FAF trustees, and he will be hard to replace. He also finishes his term in December. But the other trustees have been attentive, particularly the private company reporting committee that we report to and with. They've attended all of our meetings and they have been engaged. And of course, as I get into my comments a little bit later, one of the critical things for this process to continue is their dedication to that as FAF trustees. And they're being set up with people who are private company centric to help lead that, like Mac Lawhon has done. Thirdly, I really appreciate the FASB board members. They've been great to work with, very apprehensive as we got started. That first 3 days I spent up there getting to know them was kind of like a bunch of new dogs in a park. And it was interesting. Apprehensive is how I would say that. But they've been good to work with. They've been receptive for 2 reasons. One, I think we've done our job well. We've tried to stay within the boundary lines that have been set. And number 2, they were told they had to do this. So the FAF trustees and their strategy really is well vested with the FASB board members now, and I'm sure the new ones that will be appointed as these other ones rotate off. Russ Golden in particular is the FASB chair. Has really been good to work with. He gets it. He understands the issues that the private company stakeholders have, and I say stakeholders, I'm talking about the users, the preparers, and the practitioners, and has been very good to work with, very helpful in leading some of the changes we needed to lead. And then thirdly, I want to thank this group. The resourcefulness of NASBA has been, second to none, as it has been with the AICPA and their technical issues committee and others that we've been working with. But the resourcefulness, the willingness to consult on different issues and approaches with this body, with its leadership and others has been outstanding, and I really do appreciate it. Progress. You got my slides, as I mentioned. I'm not going to go through them. Let me just take you through our progress and the upcoming attractions just kind of by word. And I don't really have any particular slides that I would look at as we go through. I'll just leave it right here. This slide is what the accounting standard setting process looks like where you go through. We will have in a meeting, someone will bring up a topic that'll come from one of you or someone on the AICPA or a practitioner somewhere, and we'll start kicking it around and we'll decide if we want to study it. If we do, then we'll set up a preliminary agenda item We'll have the staff go do some very focused research on it, look at the scope, see if we can find what I call a seam in the accounting standard where there's an issue of relevance for private companies versus public companies that helps us move into the area of relevance that may be needed. And then we look at some of the cost and areas like that. So key thing for any change or alteration of accounting standard is to identify an issue of relevance to private companies versus publics, and then also determine if there are a lot of other reasons why you might want to make a change, such as excess cost, confusion, difficulty in deploying the standards and the like. One of the things that I saw when I was on the Texas board way back there in 99 to 05 was that we would have practitioners come before us that would have issues where they had a really complicated accounting matter that would find its way into a fairly simple set of books, and they just missed it. And I often wonder to myself, whose fault is that? You know, and it's so easy for wise people when they are putting together accounting standards to give consideration to the street, to Main Street, to the practitioner, to the user when they're coming up with these standards, and whether or not there are exceptions or modifications that could be deployed to promote simplicity in the case of some of these applications versus the complexity that you might see in other more robust, for sake of any other word, presentation or activities that you have. For example, Goodwill Accounting. One of the standards that we passed was Goodwill. We reintroduced amortization of goodwill. The theory of Goodwill is that goodwill impairs over time, kind of like you shed skin when you sleep. And you're supposed to determine on a daily basis when there's been some impairment that's been substantial enough that you need to sit down and revalue it. In fact, you're required to revalue it annually and pay someone to come look at it for you. Same thing with intangible assets. And so what we looked at was the cost of doing that versus the one-time user of goodwill on Main Street that might make an acquisition and have goodwill being forced to have the cost of maintaining that account, as well as the risk associated with dropping everything they're doing when they're running a small company or whatever, and identifying impairment at an appropriate time, accounting for it, going through the 3 levels of impairment and that sort of thing. So we ended up, making a long story short, with impairment of goodwill going back to a one-step test, which is a trigger event, and trigger events are defined in the standards already. The plant burns down. Okay, you have a major recall of all the products like Bluebell Creameries or something like that. You have a triggering event that causes you to reassess where you are. Absent a triggering event, you amortize. We picked 10 years. Why we picked 10 years? I'm an Aggie, I can divide everything by 10. It's just that simple. We thought about 15, that's tax life of amortization of intangible assets, including goodwill, and we decided we did not want to write into accounting standard, as I suggested. We don't want to write into accounting standard the IRS tax life because it could change. And so we came up with 10 because that approximated the life cycle of most acquisitions before they morph into other products and services or things like that. So 10 years accompanied by a one-step triggering event, amortization or impairment of goodwill. And then we allowed it to be implemented for all goodwill. It was on the books at the day of implementation. Simple approach. Now, that makes a lot of sense. In its simplest form, that illustrates what we're trying to do. I'm not going to take you through all these different standards and things we've gone into because some of them are pretty esoteric. That's why I'm trying to get out. But that's the point, is that relevance of goodwill, amortization, impairment to these Main Street companies was not that loud. And their users were focused on cash flow, particularly 5 years worth of cash flow, because that's how the money comes in, that sort of thing with the lenders and or investors. And so EBITDA ruled, not earnings after depreciation or earnings after amortization. And so in those cases, you can now elect this new alternative to amortize goodwill over 10 years and follow the impairment rules and that sort of thing with an appropriate accounting policy disclosure. And the world is still round. The sun still comes up, and all the naysayers are still quiet about that. Because, oh, what happens if you go public? If you go public, you got to unravel it. What happens if we get acquired by a company that is public? You have to follow public company standards, not this alternative. You got to unravel it for all periods presented. What's so bad about that? Well, that's the reason why we shouldn't exist. That's the reason why we shouldn't be doing this. And my response is that it's a cost of that transaction. If you want to be bought by a public company, you want to go public, a cost of that event is to go back and recast your financial statements and unelect those alternatives that you had. And so it's just not a reason for 95% of the relief to not be out there. So that's what we have going on. Okay, to date, the progress and protocols established by the FAF and FASB we've had 4, through that process, we've had 4, and then you see the process on the slide here. We go through deliberation, feedback, more deliberation. Again, the FASB's at the table with us, and we end up with us proposing something to the FASB. We have to vote, have 7 votes, or a supermajority of our PCC to vote something out to go to the FASB as a recommendation. They have to only approve it or disapprove it by a simple majority, 4-3. And so far they've approved all of our things 6-0, 6-0, 6-1, 6-1, 7-0, and 4-3. So I don't know, I don't think that's a trend, but they just didn't like intangible assets. They had a problem with that. But then when we propose a change that goes to the FASB, they have 60, count them, 60 days to respond to that proposal and then tell us publicly, tell us directly and publicly if they approved it, if they didn't approve it, and if they didn't approve it, why they didn't approve it, and also tell us what has to be changed for them to approve it. And there's a lot of dynamic that works in that process, and we need to retain that going forward. So we put out 4 standards so far, ASUs as they're called, accounting standard updates that have been proposed by the PCC. In these, they propose, and I'm not going through them, they provide modification alternatives to existing GAAP in the areas of goodwill and intangible assets, accounting, and a business combination, a simplified hedge accounting approach to certain interest rate swaps, and a modification to required variable interest entity consolidation rules under certain common control leasing arrangements. That's a mouthful, but in each one of those issues, there were some very simple issues that had to be addressed that we got done. These new elective private company standards arose from the feedback that the PCC received from many stakeholders who were concerned with these issues of relevance together with excessive costs, as I mentioned earlier, and maintaining their financial statements under the pre-existing standards. The other thing I'll mention is that we have a private company decision-making framework that we put together. It may be on these slides somewhere right here. And it's a 250-page document of 10, it's got about 10 pages of good stuff. And what it does is it is a mutual understanding between the FASB and the PCC that we voted on. It also went through public process of input that recognizes the differential factors between public and private companies. And you see some of those listed right there. And when you look at the ones down near the bottom, accounting resources, learning about new financial reporting guidance, what that really is meant to say is that the division between practitioners, users, and preparers is pretty interrelated, interactive in private company markets as it is with public companies where you're prohibited from having a lot of interactions because of the public companies. But we agreed on these differential factors that are all talked about in modules. We talked about some fundamentals in the framework. We talked about lookbacks as well as looking at new decisions being made by the FASB going forward. And we got some good input in that process, but it helped us to kind of agree on the ground rules for this and put some fence around it, so it helps. And it's still out there and we still follow it. We had to go through and define a public business entity as well, and this is now the definition that follows in all the new standards issued by the FASB. There are some old definitions in there for some of the old standards that are grandfathered, but as those standards go through any rehabilitation or changes, this definition will follow with regards to the new ones, and that's the 5th one there. So, again, these alternatives that we're working on with the FASB to address these concerns are unconditional one-time options and things like that. One of the things that we are addressing currently is with regards to the implementation of a standard. If you don't have goodwill on your books until 2016, can you can you elect the Goodwill alternative even though the implementation or election period has passed, and we're having to go back and issue another standard that addresses this so-called transitional guidance. And that's being looked at now. We'll be talking about that more at our next meeting. We're going to be getting some feedback in a couple of weeks at the NATS conference that'll be in Baltimore. NATS is the SEC conference for private companies, if you will, that the AICPA hosts. It's called the National Advanced Accounting and Auditing Technical Symposium. It's very well attended. It's a great place for us as the PCC and the FASB to get input. And among our town halls that we have throughout the year, we have one there, and we have a lot of good feedback that we get from them. We have some 16 or so program questions with answers that we will have electronic polling at the event to do that. Now, in addition to the 4 topics that have resulted in ASUs, the PCC has also initiated a lot of other discussion topics, or we have commented on FASB projects which have led to considerations for private companies as it relates to relevance or excess costs. And to name a few, I'll go through those. These topics have included definition of a public business entity, which I just talked about, development stage enterprises, development stage enterprise entities, which we initiated, and then when we did the preliminary agenda study on it, the SEC, who was among the outreach contacts, said, well, we really think it's an issue for public companies too. So Russ called me and said, what do you want to do? This is your deal. We don't want to steal your thunder. And I said, Russ, there is no such thing as our deal. It's everybody's deal. If you and the FASB will take this and put it on a fast track for conclusion, it's fine with me and it's fine with us, and we all agree with that. So that's how we do things. We're not looking for credits. There's no feathers in our hat, so to speak, that we're trying to count. And so they got that one out. They effectively eliminated the cumulative information that had to be reported and audited in development stage entities that was getting quite voluminous and difficult for no reason. We've had a lot of input on the disclosure framework project that the FASB has. It's continuing. We had a lot of input on the going concern accounting standard that they issued. We concluded that there really wasn't reason for, and we couldn't find a reason for a difference in private companies versus public companies with the underlying responsibility that's set out in that standard, which is that their standard, the responsibility for reporting going concern vests with the company and not the auditor. There's audit considerations that the audit has, but the company has a gap requirement now to make appropriate disclosures around substantial changes that are occurring or could occur that are contingencies associated with the company's ability to continue as a going concern. So it's no longer just an audit responsibility, it is an accounting responsibility of the preparer. Government assistance accounting and disclosures is continuing. You wouldn't believe all the government assistance is out there, and there's really no accounting for that. I don't know if there's going to ever be a standard that addresses it because there's so much, but it's a consideration, it's a project that the FASB has going on that we've been commenting on and keeping up with. Revenue recognition, you know well about that. Revenue recognition was pretty much out the gate when we were formed, but we got some input on the transition and we're able to get an extra year of transition for private companies. We didn't really, our predecessor entity had the input on revenue recognition accounting. Me personally, I don't like it because it's a convergence standard and it's a 730-page document that's principles-based. There's not a book in the Bible that long. And it had to be immediately issued with a transition resource group that had to be formed to try to convert it into something that was rule-based so we could all follow. Why? Well, because state boards of accountancy want to know what the answer is. Courts want to know what the answer is. The SEC, in many cases, wants to know what the answer is. A principle-based standard just doesn't fly. You have to have some interpretation, conversion to rule, which is my problem with IFRS and convergence, is that we're creating a lot of additional work. Lease accounting is going on. We've had a lot of input on it. It may surprise you to know that we don't like it. We didn't like the first draft that came out. It was very complex and complicated. We even wrote a letter. They asked us to write a letter, and we said, we don't write letters. We're just going to vote and tell you we don't like it. Well, Russ said, if you would please write us a letter, we want to use it when we go over to Belgium or somewhere. So we did, and we basically said, we don't like it. There's not a problem. We don't know what problem you're trying to fix over here. This is all in the interests of international politics and international harmony, and we don't know what the problem is you're trying to solve with regards to putting leases on the balance sheet when it's simply a right to use and not a right to consume. And we're still dealing with that issue. We got 4 questions around that at the NATS conference coming up. And one is, do you believe that a commitment to make payments creates a liability? And they'll say, yeah. And we said, okay, do you believe that a commitment to make payments, or do you believe that the right to use an asset but not consume it creates an asset? And they all say no. So that's the problem. The FASB is focused on the liability. It says, liability, you got to book it. And we said, well, but where do you book the asset? Well, you call it an asset. Well, it's not. It's a right to use, not consume. And so we're at an impasse on that, and we are not giving in. I don't know where it will go, but the current standard says that you take your lease commitment disclosure for operating leases, which are called Type B, the amount that would, the interest, the stuff that goes into the footnotes, you have to discount it and put it on the balance sheet at your financial reporting date. Then you take it off and just keep booking lease expense. But then you put it on your books at the balance sheet date. And because it's really an asset and a liability, and that's why we got to do that. Well, we still don't like it. Accounting financial instruments, classification and measurement, we had a lot of input on that. That one put me to sleep, as it would you. Certain partnership accounting issues, some robust questions that came to us from the NATS conference last year that were addressed. One of them in an EITF. Uncertain tax positions, we've addressed that in a lot of different places, but worked with AICPA with regards to disclosure of open tax years to solve an unintended consequence. It was in one of their documents where we got the FASB to clarify their intent of the rule so that the absence of disclosure, so you wouldn't be required to disclose immaterial open tax years. It was causing a problem in peer review. Share-based payments, mouthful. Share-based payments, stock compensation. If any of you have long memories, you remember Bob Hur's getting ripped up by Congress. And you remember that that's a very politically charged issue. Nevertheless, we said we're going to open it up if y'all don't, because we think that there's a lot of relief needed for private companies. And so we went into that. I'm going to show you just a list of what's in that one. See all the stuff I'm not making you listen to? Right there. Now, you can't read that, look in your book, if you can read the book. But on share-based payments, we said that there's a lot of issues that need to be addressed with regards to private companies that just don't matter. And so the FASB, and we told the FASB we're going to begin, and we talked about a lot of them in a meeting, and we decided that we're going to open up some research. And the FASB said, why don't you let us do that too, because we think really that public companies need some of this addressed for them. We said, fine, but 4 or 5 of us are going to be on your task force to look at that. So we have some very significant input, and we're watching it closely to make sure something happens. An exposure draft was issued a few weeks ago, and these items are in there as rehabilitation to that standard. I don't know how significant they will be to everybody, but they will apply to public and private companies that begin to simplify some of the issues. To date, the PCC has not found an additional silver bullet beyond these, but we're still looking before we endorse this standard, and we got a couple of months before we'll do that with regards to share-based payments. And so this standard, or this approach to share-based payments exposure draft, is coming out of the simplification initiatives of the FASB that was spawned basically from our existence, and has the same, the simplification initiatives have the same ambition that the PCC does, and so we're having comments on all of these. In fact, bringing some items to them to be considered. But some of the simplification initiatives that we have been working on, including share-based payments, includes presentation of debt issuance costs that just came out, elimination of the concept of extraordinary items, measurement of inventory, which is the lower of cost or net realizable value simplification there, equity method accounting, removing consideration of a basis difference and the retroactive application requirement for those 5 of you or so who may follow that, simplification of the balance sheet classification of debt. We have some considerable discussion and concerns about that proposal. It is born from a IFRS or a convergence type approach where the rule is in Europe, if you will, that you classify all the debt on your balance sheet according to its legal terms, period. And anything that happens subsequent to the balance sheet date but before you issue your financial statements does not matter. We believe that it'll change all the banking rules around the country, especially with the community and local banks that are having to deal with companies that they basically keep very on a close leash, and they set and they'll renew those loans and or waive those covenants after they see a draft of the year-end financial statements, cash flow notwithstanding. And we believe that this classification, which the FASB up to this point fervently defends, is something that's got to be addressed, and we think that they're wrong. The MAC clauses, the SAC clauses, and all the things that you have in loan agreements today can cause all those notes to be classified as current under their proposal, including any rolling of the note after the balance sheet date doesn't matter. And we said that's just going to destroy the concept of net working capital completely, and we don't agree with that. So that one's still being looked at. We have opened up a topic, a new issue introduced at our last meeting dealing with certain aspects of VIE guidance to private companies under common control that we'll be looking at and that sort of thing. And before I want to leave the technical topics, and that's kind of a quick overview of what we've done, I have to remind you that complex transactions will result in complex standards. And just because they're complex is no reason for private companies to not follow them. So if your client or someone that is reporting to you or has issues or brings another CPA into an enforcement action has a very complex transaction, they have to address the accounting for these transactions and be very careful. There's no substitute for diligence on the part of the preparer. There's no substitute for diligence, knowledge, and use of resources on the part of the practitioner. But what we've been trying to do is in the standard setting process, introduce a culture of, wait a minute, is there a Main Street alternative or a Main Street consideration in this standard that ought to be addressed given the complexity of the standards? And so, and the other thing I'll point out is that since we are a deliberative body, it's been suggested by many that we should be writing opinion letters on all these things. And the answer is no. 9 of our members have day jobs. We're a deliberative body. The reason we meet in Norwalk with the FASB at the table is so we can tell them what we think and what you think about things. And we're not going to waste a lot of our time writing letters. We're going to talk about it. We're going to vote. And if somebody else wants to write letters, they can. Our only exception was a lease standard because we were so passionate about it. Input. As you know, it's much easier to secure outreach and other feedback from the stakeholders of public companies, including their users. It's easier to do that. The FASB and the standard setting process will go to a trusted small group of people to get some initial outreach. And that's good, it's efficient, but it has to be a broader group when it comes to private company standards. And one of the problems that we've had with the FASB is that we think their outreach process needs to be revitalized and broadened given the social media that we have, the possibilities we have with people in this room as well as people at the AICPA that all have contacts of people that we can put into a database to ask questions. The outreach just has to be more robust because it's resulting in this. It's resulting in the formulation of a point of view with FASB staff and with the FASB board members, which is difficult to change once they form a point of view. And so our point is, and our real drive right now, and we're going to spend a lot of time on it at our next meeting, is that we've got to change this outreach process initially before points of view are established. And we think that that'll help the standard setting process. Russ agrees with that, and we're working on that. So we've had a lot of input as we try to make this cultural change to these traditional methods. We took, as an expansion of the roundtable format that the FASB followed, we created the so-called town hall approach where users, preparers, and practitioners in these geographic areas were invited to gather, hear about topics, updates, comment on these items, and then have an open mic for new issues that they wanted to talk about. At these town halls, we have a panel of 3 PCC members. We rotate. We have 3 FASB board members. We can't have 4 because then it would have to be a public meeting, plus a moderator, which is generally me. We had Diane Rubin moderated at one of the meetings, one of the town halls at the University of Washington. And before I pass on Diane Rubin, she has been great on the PCC. She has done a great job. Practitioner, she just retired from the Novo Nordisk company. She's spoken at a number of the NASBA meetings. She's a former chair of NASBA. Diane Rubin has really represented you well as the stakeholders for private companies. She will be rotating off this year as well, just because she has other personal things in her life she wants to do, and this isn't on her bucket list either. But to date, we've had town halls in Columbus, Ohio at the Ohio State University, in Seattle, Washington at the University of Washington, in Dallas at SMU. And in Dallas, for instance, the Texas Society of CPAs helped us organize the event, publicized it well, and provided 3 hours of CPE. And we're expecting that profile to grow with our town halls. The BASB board members have kind of grown to like and look forward to the town halls because we have it on a significant college campus. It has a significant accounting program. There's opportunities for interaction with students and with faculty. It has to be in an area that has a lot of stakeholders for private companies, with users, preparers, and the like, because it's their feedback that we're trying to drive from these meetings, but it's worked very well so far. And I mentioned at the AICPA at the NATS conference in 2013 I spoke, and that laid the way for us to have a town hall at the 2014 meeting and again this year. And then we're going to also have a town hall at the AICPA's Controllers Conference in November, which I think is in Orlando. Despite all of this outreach, as I sat with the FAF trustees when we were first getting started, what's the biggest challenge? The biggest challenge is feedback. It's such a large, broad group that you have to draw from and have to get information from. You can't just go to a handful of people in back rooms on Wall Street. And that was going to be the challenge continually, and so we're still working on that. Am I satisfied with it? No. Good start, but we've simply got to do more with the outreach, as I mentioned earlier. Feedback. So how am I doing on time? Did Noel quit and go home yet? Noel Allen? Thanks. You got me. Sorry. Oh, yeah, right. Yeah, right. All right. Well, I'll make a lot more sense when I have a beer in my hand. Okay. Since the fall of 2012, when I got into this, I've spoken on many occasions around the country, and we've had 13 PCC meetings in Norwalk so far. So far, I've met twice with the FAF trustees, as I mentioned, in 2013 and 2014. In addition to back surgery, which I had to have, my dog hurt my back, I had about 36, and in that year, I had 36 PCC presentations around the country in 2013 and 2014. I didn't turn anyone down, and the ones that where we had conflicts, I got other PCC members to go do that. Why? How do you not do it? You've got to. If you want to get this known, and when you ask people to raise their hand, how many know what the PCC is or what it's all about? Nobody. It's growing now, and you have to get out there around the country and do that, and in what I call Main Street. So I've been out there. I'll probably do about 10 or 12 presentations this year. The highest concentration was 2014, where I did about 23 plus the meetings in Norwalk. And they were all very good. 75 dog days. Because they asked me, how many hours does it take? And I said, well, it was 1,800 hours in 2014. Well, how do you measure that? I said, I spent 75 nights on the road, and my dog says those are 24-hour days. So that's how I got, actually probably about 1,000, 1,100, something like that, if you measure it in partner-charged hours for the honest partners. But anyway, from this input, why do this? Not just figure out what the program is, let people understand, but get their input. Write it down. Let them come to the mic. And that's what we did. And if many of you have been at some of my events, you know we've done that. And so we've gotten considerable feedback from Main Street. Here's some summaries of some of the feedback from Main Street that I'll take you through quickly. Number one, today, where we are with all of this, Main Street is cautiously optimistic and encouraged by the PCC and the FASB results to date. Cautiously, these are surly people just like you and me. Show me more is what they say. Results matter. Why am I writing all these down? I take them to the FAF. The FAF says, hey, you're pushing too hard. Yeah, I said, no, we're not. We're just getting started. You're just used to little push. There's a lot we got to do. Don't move slowly is another quote. So, if you will, we're off to a good start given those comments. Now, the mission and scope of the PCC's carefully constructed relationship with the FASB should continue, they say. Don't do anything to handicap the initiatives and results. The look-back process on existing standards that we're looking back at for rehabilitation and applicability to private companies is never complete. The number of PCC meetings per year should not decline. Greater PCC practitioner involvement may be needed. Why? The 3 practitioners on the PCC are worked to death. Why? Well, because they know all these issues. They're technical leaders in their mid-sized firms, and they're go-to people. And oftentimes the preparers or the users can't do that. And so there's an opportunity for us to add a little bit emphasis to the PCC practitioners in the makeup. The EITF, in fact, recognizes that and does that. It's Emerging Issues Task Force. All FASB board members must be committed to the private company decision framework and issues of relevance and cost containment. Why do I say that? This has got to be on the checklist for interviewing new FASB board members. They got to be committed to this for this culture to be in place moving forward. The PCC must continue to report to a FAF trustee committee dedicated to the PCC's mission. You won't have private company-centric people on the FAF trustees if you don't have a dedicated committee that they have to man and woman be on and attend our meetings. If this becomes merged in with another committee, it gets diluted out, and you have the opportunity for us to morph right back to where we started. The FAF trustees must remain strategically and visibly committed to the mission of the PCC. Visibly committed. Their makeup must continually be scrutinized. By who? I don't know. Maybe Congress if they have to. But FAF trustees are selected in a clandestine manner, and the clandestine manner typically doesn't meet with public approval. And so they're going to have to look at that very carefully. The FAF trustee private company stakeholder representative must grow and not decline. Independence and objectivity must be the cornerstone of the FAF strategy and leadership and accounting standard setting. This is the single reason they exist. Back in 1973, the Wheat Commission came up with a report that said we need to create a FAF and a FASB. Why? Because standard setting needs to be independent and objective. SEC can outsource their standard setting to the FAF, but it's got to be outsourced to them, not dictated to them. We are losing sight of that today, where we just believe the SEC runs it all, and the FAF does too. I think that there has to be a concerted effort to focus on the responsibilities of the FAF trustees, because just like each of you, they hold their position because they're independent and objective. The IFRS and IFRS Convergence issue needs leadership and decisioning now by trustees. Main Street says, why are we waiting? Should the PCC effort, and I'm on my last page here, should the PCC effort begin to wane, serious considerations will need to be answered about the path forward for accounting standard setting in the U.S. By wane, I mean the proposals begin to drop, the efforts begin to drop, you don't see much about it. Then you turn around and look at the other standard setting. Have there been considerations for the private company dynamic? At the end of the day, we shouldn't have a PCC. We should have a FASB and a committed FAF that promotes private company decision-making focus in all decisions being made. That's what the ultimate goal should be. But until then, we got to change the culture. It's going to have to take an entire recycling of the FAF or the FASB board members, I believe, for that to happen. Now, private company stakeholders benefit from the standard setting for private and public as well. But when it comes to international accounting standards, private company stakeholders have told me that it's a distraction. It's a problem. It's creating more work because, as I said earlier, you're creating principle-based standards in a rule-based environment, and it's very difficult to interpret. It takes a lot more time and work than just issuing the standard. Recently, the SEC chief accountant, at least one of the commissioners, questioned the benefits of IFRS and convergence to the U.S. markets. This issue needs leadership and decisioning now. No decision is indeed a decision when it comes to the FAF with regards to that. The FAF is waiting on the SEC, and the SEC is waiting on someone clandestine to make a decision, I guess. But for us on Main Street, we don't need to be waiting for the SEC to decide what they want to do for public companies. We need to have a reinstitution and a revitalization of U.S. GAAP as a gold standard for financial statement reporting in the U.S., and it needs to be focused on the U.S. markets and the U.S. needs. One of the quotes that I got from Main Street was, "Don't let the spirit of international harmonization disrupt our U.S. GAAP mission." And there's several other quotes that I have that I won't go through in the interest of time, but Main Street says, we can't run our business this way with standards that are not clear. We simply can't. And so this process, as good as it may be for international global accounting standard setting, we all have different markets, we all have different rules and regulations, we have different societies that interpret the data. I can issue an IFRS statement in the U.S. and I'll go ask a question in our technical office about how to do this or this, and the answer is, well, whatever you think works the best, just disclose it. That's for the IFRS opinion. But when it comes to U.S. GAAP, you got to have an answer because of, as I said, the litigious environment that we have, the drive for an answer by everybody in the network. So I guess as I stand before you today, I'm not going to talk too much more about all that stuff. You know how I feel about it. But as I did several years ago as your representative, I'm an ardent supporter of the FAF and the FASB, as this organization was when it revisited this topic completely during the Blue Ribbon Panel process and then later on. I very much support the FAF and FASB. Why? Because as we are trained in this group here to be, our concern is the public issue, the public needs, the public perception, the public service. And the design of the FAF is intended to be independent and objective and serve the public interest through robust input process to gather what the public's issues are, what the needs are, and to address them. But having this experience of deliberation coupled with Main Street exposure, I can confirm that the concerns about the private company accounting standards and GAAP have improved, but it's nowhere near resolution. So the PCC process at this time must continue with the clear leadership resolve that I've talked about. And until I'm done, you obviously have my commitment to this. I'm not through. I will chair this body until my last day in December. And then I will ardently support the new chair and any of the new members of the PCC, as you would expect to be the case. But I will tell you this, I'm not going to go back to an armchair and be an armchair quarterback like some of these past FASB board members and write all these stupid letters about the old days. We have to be contemporary about this approach. We have to find out what the needs are of the public, and we have to address those in a very contemporary fashion. I'll be glad to answer questions probably after the meeting or during the break since I've gone so far over, but I thank you very much for your time and your attention.